Well, it was a roller coaster session. I saw the Dow spike. Remember, earlier in the day, we spiked almost 200 points. This on initial reports that the United States had extended an invitation to China for high-level trade talks. What we learned from Larry Kudlow later on this afternoon on Fox Business, the invitation came after an overture from China. Then, of course, after the spike, we started to drift, but then we had a nice little bounce here. And the blue chips were up, the S&P was higher, NASDAQ even came off its lows. In the meantime, we had the Beige Book report, and we could see the economy doing very well, but the trade battle starting to rear its ugly head. For the most part, everyone's talking about modest to moderate expansion, but the only concerns, again, trade and a lack of skilled labor, right? Just a labor shortage, a lack of skilled labor. It really continues to haunt at least some of these manufacturers and businesses. Overall, though, the message in the market, consumer staples and value investing, that sector rallied behind the cigarette stocks. This after harsh comments on e-cigarettes from the FDA. E-commerce, right? Demand spurring job creation. FedEx going to hire 55,000 temp workers. Macy's will hire 80,000 temp workers for this holiday season and almost 24,000 just for fulfillment. Technology continues to struggle. Apple made a lot of noise today. We had that big product event that saw an array of new products, including its most expensive model ever. The company's stock continues, though, to reflect management's focus on high-price, high-margin smartphones instead of volume and market share. Maybe that's why the stock changes hands at such a very low valuation metrics. Think about this for a moment. If Wall Street valued Apple the way they valued Amazon, it would be a much higher stock. If we use the forward PE, it would be $1,063. If we use PEG ratio, it'd be $371 a share. So let's digest all of this with the panel, beginning with Apple. Shah Gilani's with us, editor of Capital Wave Forecast, and Erin Gibbs is back with us as well. Shah, let's start with Apple. Big event. Stock didn't do much, but that's not unusual. Typically, after these events, 60 days later, the stock is higher. But what do you make of that? It's a $1 trillion market cap, but I think people forget the PE ratio is only 16.
You had all those metrics that I think people forget to look at. And by all of those metrics, it is an undervalued stock. It continues to be an undervalued. It's been undervalued for a long time, and it continues to go higher because it's undervalued. People come to the game a little bit late. Warren Buffett came to the game late, figured it out about 200 and bought a whole lot. So the price of the stock is really, I think, a function of this future earnings potential, which are, in my mind, unlimited.
But, Erin, it's $220 a share. If it traded at the forward PE of Amazon, it'd be $1,000 a share. Does that tell you anything, though, about Wall Street's reluctance with this company, that at some point they think the magic will fade away?
Yeah, I mean, there are already concerns, and it's not just profits. They've been able to hold steady on earnings growth, but when you look at revenue growth, that's slowing versus Amazon's that's increasing. And then so when you look at some of these really the forward metrics, there's definitely concern about just how many more iPhones, particularly that high-end market, are you going to be able to sell? And yes, we were all impressed that they could break the $1,000 price level from last year. Right. But, again, this announcement, there's nothing really that amazing, that compelling that might, if I want,
it's still
users,
it's still a smartphone with a better camera, maybe.
Exactly, and a dual SIM cards. But so is everybody going to go out?
The market has been looking at those issues for years, and the stock has been moving forward upwards in spite of those issues. Now, the earnings rose 17%. Excuse me, revenues rose 17%. Earnings rose 40% last quarter, ending in June 30th. The future quarter, the management has expected and presumes that they will rise, revenue will rise 16%.
Sure.
That's a tremendous rise from a stock that's already gone tremendously high, set new records, $1 trillion valuation. They're telling the market, we expect further growth, further revenue growth, further revenue and product development is going to drive that.
And last quarter,
we have more profits coming with the stock is going to a lot higher.
Last quarter, average selling price was up 19%. By the way, last quarter, America grew faster than China. America was up 20%, China up 19%, and it's twice the size. Let's circle back to value, because every time I see these techs shaky like this, you wonder if tech ever really does fall apart. Will the money find its way into other areas of the market, or will it go to the sidelines? I know, of course, Philip Morris and Altria won't be the ones that lead the way. but you do see signs that consumer staples, a lot of tire kicking there, and every now and then those stocks do well.
Yeah, and we saw just in the few days where we saw concerns over the social media stock where there was increased regulations, all the money really went into industrials and staples. Coke was one of our favorites that did really well. Another time when you see concerns about tariffs and the semis really get hit really hard, you see money going in, again, staples, industrials.
Should investors out there watching this, knowing that that these stocks may not zip every day, though, but they present amazing value, should that be something that's present in their portfolio?
We believe so. We still see growth doing very well and probably outperforming value for the end of this year. But when we look at 2019 and we see a massive slowdown in earnings growth in the tech sector, it's actually going to have slower earnings growth than the S&P 500 forecasted for 2019. So that's a time where you may really want to change your portfolio.
Shah?
Growth has outperformed value exponentially, and it's going to continue to outperform simply because growth is where it's at. Because you look at the social media stocks, you look at the tech stocks in general, the big basket of tech stocks, that's where the revenue is going to. That's where the profits are derived. That's where the money is going to in terms of investors putting their money. The rest of the stocks, the value stocks, become undervalued, underbought, underowned, and then become value stocks. So they can get bid up after the fact. But the tech stocks continue to lead the market, and they will continue to lead the market.
Names big, just keep riding those bad boys until you can't ride them anymore.
I think the market has to worry about is if those tech stocks roll over, then the market has a lot to worry about.